Hi everyone, thanks for coming today and welcome to the Strategy Introduction. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading since 2002. I've been in these markets on some level since 1964 as a collector, a banker, and a licensed stockbroker. I believe that I've been groomed for this period of time, and I'm on a mission. My mission is to convert financial noise into understandable language that enables educated choices for all. A little disclaimer before we begin. ITM recommends that 5 to 20% of your overall investment portfolio be placed in precious metals. However, the decision as to how much to allocate is strictly up to you and/or your financial advisor. My opinions may or may not reflect the opinions of ITM Trading. I suggest you grab a pad and pen before we get started and just jot down any questions that come up. We'll have time to answer them at the end, or give us a call. As you're about to see, we are keen on educated choices. As a stockbroker, I was there on Black Monday in 1987, and I can tell you for a fact that everyone was shocked as markets imploded almost 25%. Now, I cut my teeth on bonds, and more specifically work with non-dollar denominated bonds, which is all about currencies, and that's what led me to begin my studies in currencies. This is when I discovered that money has a recognizable life cycle that includes some simple patterns and valuations. And by recognizing these patterns and valuations, there's a much better chance of being in the right place at the right time with the right asset. With that goal in mind, I developed the strategy for myself. And today, I'm sharing an overview with you. So let's begin with why understanding the strategy matters to you. Well, it matters to you because there's a currency war going on that puts your current standard of living, future plans, and wealth in jeopardy, since it intentionally erodes the very foundation the global financial system is built on, money. And while most will suffer, some will be okay, and a few will prosper. I suggest that those that prosper are those that have purchasing power when the opportunity presents itself. And that's really what this entire piece is about. But first, a little reminder about the events that occurred in 2008 that got us to where we are today, more vulnerable than ever before. In 2008, a mortgage derivative bet bubble burst, sending the world into what's called the Great Recession. AIG was given taxpayer money to pay off worthless derivative bets at 100 cents on the dollar to Goldman Sachs and JP Morgan Chase, and all the usual players. Trillions of dollars of wealth evaporated as credit dried up almost overnight. And Bear Stearns was sold for pennies on the dollar. Merrill was saved from bankruptcy by Bank of America. And the Federal Reserve allowed Lehman to fail as stock markets imploded and emergency action was taken. Interest rates were pushed down near zero. Trillions were pumped into the financial system. Emergency actions were being guided by the Federal Reserve, with the entire central bank world at the ready to open those money printing spigots wide. And that's exactly what they've been doing ever since 2008. I'm about to take you deep into the financial system and show you what these central bankers have chosen for the global financial system. I listen to what they say, but I watch what they do. Allow me to introduce you to the key players. The Federal Reserve is a private corporate bank put in charge of our money in 1913 by contract charter, and it was legalized by the Federal Reserve Act. Since the U.S. dollar is the most used currency in global trade, policies of the Federal Reserve have global impact. And if you combine the Fed with the IMF, the International Monetary Fund, whose members are all the Treasury Secretaries and central bank chiefs, as well as the Bank for International Settlements, which is the central banker's central bank. And there you have the most powerful group and influential bankers in the world. These are the guys that are driving this bus, and they're on a mission too, which I believe is to orchestrate a financial system reset. A reset is the way a government declares bankruptcy. When a government resets their debts, they devalue their currency to pay those debts with cheaper money. This ultimately creates hyperinflation, which I see and believe lies in our future. But that's also what may create those opportunities if you are in an asset that holds your purchasing power during hyperinflation. I'm going to show you all of this, so let's begin. Today we're going to review 4 key concepts. What is good money, fiat money, and the fiat money disease? The 2008 crisis is a much bigger threat today. Current legal ownership laws jeopardize your wealth, and finally, the opportunities of the fiat money disease. Your financial life depends on you understanding this, so let's start at the beginning. Since all of this is about money, you need to understand what it is and how it works. Money was originally developed to store any excess labor generated today for use in the future. In addition, a universally accepted tool would enable a society to specialize: farmers, dentists, lawyers, etc. But it also needed to be indestructible, easy to carry, and divisible, in addition to holding value over time. So for example, let's say that I'm a farmer and I put a lot of labor into growing a crop of corn. My family and I have eaten all the corn we can, but we still have excess. Well, I don't want the fruits of my labor to go to nothing, since food has a shelf life, so I take it to market. But there's really nothing else that we need at the moment. So I want to convert that excess labor into something tangible that will last until I need it. It takes labor to mine gold and silver, which therefore made it easy to value labor against labor, and thus could be a standard against which all goods and services could be fairly valued. Over the years, many forms of money have been tried, but only gold and silver ever met all of the criteria, and that's why they've been used as good money for the past 6,000 years. So now let's take a quick look at those key criteria. Good money embodies 4 critical functions, which are also known as the 4 pillars of money: a unit of account, a medium of exchange, a unit of deferred payment, and a store of value. In this way, you can save that excess labor that you generate today and buy the same amount of goods with the same amount of money in the future. That's purchasing power integrity, which is the most important function that money performs. In addition, the gold and silver content in coins were standardized, divisible, and tangible, which made gold and silver easy to use global tools of barter. Importantly, when coins were used as money, individuals held them and owned them outright, and that wealth was held outside of the banking system. But the gold standard is constraining for governments and central banks. So they entered into contract money called fiat, which is borrowed into existence by governments and created those central banks. Fiat money appears to mimic good money, which is how they get away with the lie. But its most important function is inflation, which guarantees that you cannot buy the same amount of goods with the same amount of money in the future. And thus, purchasing power is lost over time. We've all experienced this. Now, prior to 1913, the U.S. was on the gold standard, with 1/20th of an ounce of gold pegged to every $1. After 1913, that peg was shifted to 1/20th of an ounce, now pegged to $2.40. By 1928, those pegs were breaking down, and so were the markets. The 1929 bursting of those bubbles ushered in the Great Depression. All confidence in the banks and the fiat money system was lost. In 1933, laws were changed. Governments and central banks became the only legal holders of monetary gold. And once those laws were in place, the gold dollar peg was shifted again. This time, a 1/20th of an ounce of gold backed $4. Fast forward to 1971, when the final peg to gold was broken by President Nixon, and the U.S. dollar as pure fiat was born. So the dollar that we have today isn't backed by anything except debt and confidence. After that, most currencies were free floating and were mirror images of each other, like you can see in this chart. But in the mid to late 90s, most emerging market currencies repegged their currencies to either the US or the euro dollar. But those pegs began breaking in January 2015, when the Swiss franc violently depegged from the euro dollar, with the most visible current peg shift between the Chinese yuan and the US dollar occurring on August 11th. When that happened, the global markets began to deflate. And this is where we are right now. But there's only one way to fight deflation, and that's with inflation. It's the only tool the central banks have left. History tells us that the most likely outcome of this mass money printing is hyperinflation. And when all confidence in the currency is lost, that cycle comes full circle with a currency supported by gold again. So the public will have confidence and use that currency. This represents the purchasing power life cycle. The dates reflected in this life cycle reflect the backing shifts that you just saw from the good money system to a fiat money system. So you can see that the peg is related to how much fiat money can be created, but the backing relates more to purchasing power. You might recognize this loss of purchasing power as inflation, and it should be clear from the fact that the dollar that bought 20 loaves of bread in 1912 can only buy a fraction of one loaf today. And it's all by design, and they're telling us they're not done yet. It's not enough. This chart from the Federal Reserve between 1913 and 2015. Can you see that while at times the erosion of purchasing power was slower and other times faster, regardless of the speed, it has relentlessly marched towards zero since the day central banks got control of our money supply. Now, putting those two cycle graphs together, can you see that inflation is that fiat money disease? But good money cannot be inflated away. The current fiat money experiment made the 2008 crisis possible, because without the ability to print money without limits, the Federal Reserve would not have been able to prop up the housing market, and the derivative contracts that imploded would never have existed. But what's even more interesting is that 2008 was never fixed. It was simply papered over with more fiat currency, the very thing that started this mess to begin with. But now that you know that the root of the problem on a very basic level, let's talk about why we believe the crisis of 2008 was just a warning. The entire fiat money system is intangible, and it's based upon complex contracts created by and for banks and supported by ever-expanding levels of credit and debt. In this way, financial corporations have the ability to create new financial products out of thin air. The most dangerous of all products are called derivatives. A derivative is derived from something, but can never be converted into anything other than fiat. Most are created off balance sheet in private transactions on the OTC market, meaning they're out of sight of investors. It was a mortgage derivative explosion that triggered the 2008 crisis. Did you see it coming? And because we haven't experienced another severe panic yet, since then, I should say, many people think that the issues that have been resolved. But according to many government and central bank reports, the issues that created the crisis are far from being resolved. Rather, those issues have only grown bigger, the markets less liquid and more fragile, making the entire global economies a lot more vulnerable. Most people seem to forget that in 2008, some of the largest and most well-respected financial firms either went bankrupt or were absorbed by the biggest banks that were given taxpayer money to buy those failing corporations. So the problems have simply been shifted to taxpayer and depositor shoulders. They didn't go away. In this section, we're going to look at derivatives, what Warren Buffett calls weapons of mass financial destruction. Derivative bets against the markets create an additional level of hidden risk that is now threatening central bankers' ability to support the financial system during that next liquidity crisis. The Dodd-Frank Act was supposed to move derivative bets out of depository banks, but lobbying by Citibank and JP Morgan Chase, amongst others, all of them, ensured that they remain in the FDIC system, therefore threatening bank deposits, because bail-in provisions in Dodd-Frank require all assets of the bank be used before taxpayer bailout provisions are used, and all deposits are vulnerable to a derivative default. And certainly one thing you should have learned as the current crisis has evolved, that it's the taxpayer that pays the price when these bets go bad. Because not only are we forced to bail out the financial system, but in addition, those same players sell those derivatives to mutual funds and hedge funds, thus passing a lot of risk to the unsuspecting public through their investment and retirement accounts. But these are just some of the many reasons derivatives matter to you. Now, let's see if I can put the size of the problem into perspective for you. 1,000,000 seconds ago was 12 days. 1,000,000,000 seconds ago was 1983. 1,000,000,000,000 seconds ago was 29,704 BC. Got it? Okay then, a little more perspective. This is what 15 trillion looks like. The amount of money that moves through the global economy, or GDP, is 75 trillion, or 5 of these blocks of $100 bills. Okay then, let's think of the derivative game like a poker game. First of all, this is a closed game to all but the too big to fail players. And because they're all too big, no one needs to bring money to the game. Everything is done on credit. But in this game, there's no credit limit, no reserve requirement, and if you're a big deposit-taking bank, the FDIC is backstopping your bet. Now the games begin. So AIG made a bet with Morgan Stanley, and then Morgan Stanley made a bet with Goldman Sachs, who made a bet with Prudential, and on and on and on, until everybody has bets with everybody else. And every time a bet is placed or traded, somebody makes money. Plus, as long as fees are paid, the bets never have to settle. But there are also no limitation on losses. Does that make sense to you? You have this concept? So let's just look at how big the threat is. Have you ever considered the size of the global markets and how they compare relative to each other? This slide gives you a perspective of some key financial markets. The circles represent the size relative to each other, with OTC derivatives the center circle. There are two areas in this model that represent ownership. I'm going to show you them in just a second. Gold money and equities. Now the GDP represents the money flow, and the rest are either bets or debts. Can you see the size of this? The extreme and growing amount of those bets and debts is only possible because of the fiat money system, which is infinite thanks to technology. And prior to changing accounting procedures, the Bank for International Settlements reported 1.7 quadrillion in over-the-counter derivatives. That means that the derivative market that we cannot track and we cannot see is over 2,200 times the size of all the fiat money that flows through the entire global economy. And since the Office of the Comptroller of the Currency says that roughly 79% of all derivatives are interest rate related, a rapid spike in interest rates could trigger an explosion that would make 2008 look tame in comparison. After all, it was the teeny tiny little mortgage derivative bets that triggered the 2008 crisis. And those derivative bets are dwarfed by today's interest rate derivative bets. I know you probably don't want to, but I'm about to show you why your bank deposits are at risk. This table is from the Government Office of the Comptroller of the Currency's June 2015 quarterly report on derivatives in those FDIC insured banks. You can see that over 91% of the reported derivatives are held by the top 4 banks, all deemed too big to fail. And the average derivative bet in those banks is 114 times as big as their assets, which includes your deposits, with almost all of those bets off the bank's balance sheet and opaque to investors. Bottom line, a derivative explosion in any one of these banks could easily topple the global financial system, taking your deposits as well as every other financial product with them. Now, let me put this table into visual perspective. These two towers in the middle represent the bank's assets, which includes your deposits. Can you see how vulnerable the U.S. banking system is? And with opaque derivative interest rate bets dwarfing everything else in the system, in my opinion, what I'm showing you now is a crisis waiting to happen. In the October 2015 Financial Stability Report, the IMF says that one policy misstep would be enough to topple this very fragile global financial system. And the Bank for International Settlements June 2014 report said that the central banks are out of ammunition to deal with the next crisis. And that was over a year ago. And it's only gotten worse today. And this, my friends, is a stock derivative tool that the central banks use to goose the markets. But the bottom line is that the stock market is breaking down. And that's what this chart's really showing you. Insiders are selling. Naive public is holding or buying. So this is what's happening now as the currency markets unravel their pegs. Does this look like a normal, ordinary market to you? Does it look like they have things under control and going well, like they keep telling us? It's a lie. Tangible wealth out of the system is the most conservative move you can make in the current environment, in my opinion. Because, my friends, the emperor has only one tool left: inflation. And history tells us, a very long line of history, tells us that they will most likely lose control of that too. Now that you know that the current system is much larger and more vulnerable to collapse than ever before, I'm going to show you how your stocks, bonds, and deposits are more vulnerable than ever due to laws and contracts that have been put in place. And I believe that these have been put in place to insulate the banks during the next crisis, because buried in the legal fine print in the new account agreements at any financial institution is the simple truth that as soon as you make that deposit, you have given up legal ownership of that wealth. And all you really have is a contract that says, as long as they can perform, they will. But if they can't, you lose, because legally, you own nothing. Let's begin with bank deposits. Now, Federal Reserve Reg D states that once you make a deposit into any bank account, that bank has the right to sweep those funds into a sub-account in their name and use those funds for their benefit as they see fit. In essence, you have loaned the bank that money and it's no longer yours. Now, if your bank becomes insolvent and needs your deposits, in the U.S., the Dodd-Frank bill says they can convert your deposits into stock in the failing institution. First tested in Cyprus in 2013, bailing in banks with depositor funds has occurred in several more countries since then and become the global blueprint to be used when banks become insolvent. Oh, what about FDIC insurance, you cry? Well, let's take a look. This recent FDIC report shows that they have $45 billion to insure $10 trillion. You can do the math, but bail-in is the global blueprint. So let's take a look at how your deposits and investments can be used by those financial institutions. Well, first of all, how about what you agreed to when you opened that new account at your brokerage account, at your brokerage house? All securities in your account are held in street name, with you as the beneficial owner and Delaware Trust Company, also known as DTC, as the legal registered owner. And I'm going to show you this in a minute. But I would like you to meet the owners of DTC. Do you recognize any of these names? A recent research paper done by Yale Law examined that ownership structure of all of the Fiat financial instruments. This flow chart is from that study, and that's you on the bottom, a beneficial owner. Your benefit is the ability to buy or sell, and Seed & Company is nice enough to pass through dividends and proxies and create that illusion that you really own something. But that's what it is. It's an illusion, and I'll show you that illusion in just a second. But because they're all interconnected, if one goes down, the rest will follow suit. And this is what makes them systemically important. But all of these firms and their subsidiaries beneath DTC are also legally classified as beneficial owners, which is what makes it legal to use your equity for their benefit. So if you think you own a savings or an investment account, the answer would be nope. In the contract you agreed to, you voluntarily give your wealth away. And this really does reemphasize that if you don't hold it, you don't own it, and you certainly don't control it, and therefore it's vulnerable. And in my opinion, that's because these firms influence lawmakers and write the contracts. And who among you have actually read the contract that you are legally bound by? Over time, laws have been enacted that create these layers of complicated and convoluted ownership structures with you on the bottom. So when a financial crisis hits, that wealth migrates to hidden depths and no one can be held accountable for the losses. That should be apparent from the crisis we continue to deal with. The perpetrators were bailed out, given the ability to borrow at zero, and no one went to jail. So when the next crisis occurs, and it will, who do you think will be left holding the bag? And that brings us to the opportunities of the fiat money disease. Since fiat schemes are about wealth transfer, you just need to be able to identify the opportunities. And one easy way is to do what the big money does for themselves. This chart shows central bank purchases and sales of gold. Pretty obvious what they're doing. Plus, they're on track to beat 2014 numbers this year in 2015 in gold purchases. Who knows more about money than central banks? I believe they're accumulating gold in preparation for that global financial system reset. But if a reset were to happen today, and using Jim Rickards' formula for valuation, which he explains in his books, the dollar value of physical gold is somewhere north of 8,200. Because that's where it would be if it reflected all the fiat money that's been printed versus the finite amount of gold that exists. Considering the current level of spot digital gold somewhere around $1,130 an ounce at this writing, and considering all of the previous data in this webinar, plus oh so much more, can you see that gold is ridiculously undervalued? And what do you think the central banks know that you don't? Now, let me show you the likely future opportunities, because gold and silver are the foundation of the strategy, but remember, the goal is to take advantage of wealth building opportunities as the current fiat system dies. So gold and silver are a place to park your purchasing power until those opportunities arrive. So let's take a quick look at real estate and stocks. Now, those manipulated spot prices really creates those opportunities, but the bubble popping forces deleveraging, which means things will have to be sold. Initially, cheap credit creates a tidal wave of liquidity as leverage enables speculators to push markets to new highs in terms of the fiat money. But that just distorts the markets into a one-way buy-side market that creates a bubble that inevitably pops, which forces a massive unwinding as tangibles become bargains like gold is right now. So history tells us that converting into undervalued gold today will hold your purchasing power for tomorrow and make those opportunities that are likely to arise in the stocks and real estate in the future. That's why gold should be the foundation of every portfolio, because it ensures your purchasing power into the future and can protect against long-term loss of any fiat money financial products. Physical gold. You hold it, you own it, and you control it. The future is yours if you hold and maintain your purchasing power. That's really what enables taking advantage of the strategy. And that is all about educated choices by using standard historic patterns and valuations. Now, there are two basic goals of the strategy. One is to sustain your current standard of living and then to expand your wealth base. And presuming 6,000 years of history repeats itself, this is a very, very conservative strategy, because when a fiat currency is hyperinflated away, gold and silver will once again take their rightful place and hold purchasing power during the final phase of this trend. And if I'm right, this will support financial stability, liquidity, and opportunity through that final phase in the fiat money disease. And if I'm wrong, well, as you've just seen, gold and silver will continue to hold purchasing power into the future. This is why I say it's so conservative. And this is just a taste of the strategy that we've created to protect your wealth and provide you with future opportunities. To learn more about the strategy explained and how it can help you, call your ITM Precious Metals consultant at 888-696-4653. Evidence shows that fiat money instruments are fiction, easily manipulated and out of your control. They last only as long as the fiat money they're created from lasts, and as such are simply a wealth transfer tool if they can convince you to put and keep your wealth in them. So when you look at an index like the Dow or interest rates or bonds or any of the spot markets in gold or oil or anything, you really need to look just a little bit beneath the skin of those markets and uncover the truth. Thank you for your time and attention. I hope you can see how critical it is that you understand the implications of what I've just shown you, so you won't be blindsided when the inevitable happens. And in this way, you can be prepared to take advantage of opportunities when they arise. Our number is 888-696-4653. So give us a call, because honestly, we are all here to be of service in any way we can, and we love questions, and we love educated clients. You take care now. Bye-bye.